If you want to protect your current long positions at a low cost in case the markets fall down, or make profit from the market breakless downfall by short selling the NASDAQ or cryptocurrencies like Bitcoin with low risk, the put options might be for you. Let's explore this concept in this video, and when you are ready, feel free to use the links from the description to start trading options with a professional brokerage platform. Without further ado, let's dive in.
Have you ever wondered what a put option is or why it's so important in Q4 2023? Let's dive right in and get you acquainted with this intriguing financial instrument. Picture this. You're at a marketplace, not for fruits or vegetables, but for stocks. You've got a stock that you think might decrease in value in the future. You're a little worried because you don't want to lose money if the price drops. Enter the hero of our story, the put option. A put option is like a safety net. It gives you the right but not the obligation to sell a specified amount of an underlying asset like a stock at a set price within a specified time. Think of it as an insurance policy on your stock. If the stock price falls, you can exercise your put option and sell the stock at the higher predetermined price. If the stock price remains high, you can simply let the option expire, losing only the premium you paid for the option. Now you may ask, why is it so important to know about put options in the fourth quarter of 2023? Well, the answer lies in the current market trends. The stock market is a bit like a roller coaster with its ups and downs, and lately it feels like we're on the precipice of one of those big stomach-churning drops. Market volatility is high, and many investors are looking for ways to protect their portfolios. That's where PUT options come into play. They can be a powerful tool for hedging against market downturns. If you're right about the market's direction, you could potentially make a profit from the downturn. But remember, using PUT options involves risks and requires a good understanding of the market. So a put option is a financial tool that can be used as a hedge against market downturns, and it's particularly relevant in Q4 2023 due to the current market trends. Stay tuned as we delve deeper into the mechanics of put options in the next segment. Now that we understand what a put option is, let's delve into the mechanics of how it works. This financial instrument in essence is a contract between two parties. The buyer of the PUT option pays a premium to the seller. In return, the seller takes on the obligation to buy the underlying asset at a predetermined price, known as the strike price, if the buyer decides to exercise the option. Imagine a game of poker where you're allowed to buy a card from the dealer for a certain price. You're not forced to buy it, but if you think the card will improve your hand, you can choose to do so. That's what buying a put option is like. You're essentially paying for an opportunity, but not an obligation, to sell an asset at a certain price. The strike price is a pivotal element in this arrangement. This is the price at which the underlying asset can be sold. The strike price is fixed when the option is purchased and remains constant until the option's expiration date. An expiration date is another crucial aspect of put options. It's the date by which the buyer must decide whether to exercise the option or let it expire worthless. If the market price of the underlying asset is below the strike price on the expiration date, the buyer will likely exercise the option and sell the asset at the strike price. However, if the market price is above the strike price, the buyer would prefer to sell the asset in the open market, thus allowing the option to expire. The premium, the strike price, and the expiration date are the three main components of a put option. But remember, like any investment, put options come with their own set of risks. It's essential to understand these mechanics thoroughly before diving in. So, with a put option, you're essentially betting that the price of the underlying asset will go down. It's like purchasing an insurance policy against a potential price drop, providing a way to manage risk or speculate on future market movements. Shifting gears a bit, have you ever wondered how to short the NASDAQ or Bitcoin? Well, let's dive into that. Short selling is a strategy used by investors who believe the price of an asset, in this case NASDAQ or Bitcoin, will fall in the future. Think of it like a loan. In short selling, you borrow shares or coins from a broker and sell them immediately at their current price. When the price drops, you buy back the same number of shares or coins at the lower price and return them to the broker. The difference between the selling price and the repurchasing price is your profit. For instance, if you short sell a Bitcoin when it's priced at $60,000 and buy it back when it's $30,000, you've just made a $30,000 profit. The key here is timing. You want to sell high and buy low. However, shorting isn't without risks. If the price of the asset rises instead of falling, you'll have to buy it back at a higher price, resulting in a loss. The potential loss from short selling can be substantial since there's theoretically no limit to how much an asset's price can increase. Now, why would one want to short the NASDAQ or Bitcoin? Well, in Q4 of 2023, many experts are predicting a market correction, which could make short selling profitable. But remember, these are just predictions, and the market can be unpredictable. Shorting the NASDAQ involves betting against a broad index of tech stocks, while shorting Bitcoin would mean speculating on the future of cryptocurrency, which can be volatile. Short selling is not for everyone. It requires a high level of understanding of the market, nerves of steel to withstand potential losses, and perfect timing to sell and buy at the right moments. Shorting the NASDAQ or Bitcoin can be a risky venture, but with careful planning and understanding of the market, it can also be profitable. As with all investments, do your homework, stay informed, and never risk more than you can afford to lose. First, we delved into the world of put options, a financial instrument that grants its owner the right, but not the obligation, to sell an asset at a specified price within a certain time frame. It's a powerful tool that can provide a safety net against potential losses in a bearish market. We then ventured into the realm of shorting, focusing on the NASDAQ and Bitcoin. This strategy involves borrowing shares or crypto, selling them, and then buying them back at a lower price to pocket the difference. However, this comes with its own set of risks and rewards. In the final quarter of 2023, these strategies could prove invaluable. With the financial landscape constantly shifting, understanding put options and shorting can arm you with the knowledge to navigate through the ups and downs of the market. So, whether you're considering buying a put option or shorting the NASDAQ or Bitcoin, it's crucial to understand the ins and outs of these strategies. Happy investing!
Hey, before you go, press the like button as a thank you note for us, and comment what other problems or questions do you have that we could solve for you and others. Take care.